Hi everyone. We are going to start moving on and talk about profit. So within the idea of profit, we are going to have 5 or 6 definitions. This is a definition-rich module, and I think the most important thing we can do prior to discussion in class is just make sure that we have a solid understanding of the definitions. So we're going to discuss explicit and implicit costs. We're going to discuss accounting profit and economic profit and how those two are different. We're going to talk about the implicit cost of capital, and we'll do a review of what capital is. And we're also going to talk normal profit. So let's get right into it. Well, in its simplest sense, profit is total revenue minus total cost. Sounds simple enough. Total revenue, as we learned from prior classes, is really on, if you're looking at a graph, price times quantity. So remember the triangle, or rather the rectangle, price times quantity gave us total revenue. Total cost, that's what we're going to start talking about tonight. Total cost is the cost of all the inputs used to produce the output. Let's think in sort of a traditional view of profit. Profit being total revenue minus total cost. Use an example of a sandbag business. So let's say that we've sold 500 sandbags at $5 a bag. Gives us $2,500 in revenue. So that's total revenue, price times quantity. And we have the following costs: sand, $250, bags, $500, labor, $1,000, and some costs of machinery, $500 for that. Well, if we take $2,500 minus all of those costs, we get $250 in profit. The question we have to ask ourselves, and what we'll understand better at the end of the night tonight, is, are these all of the costs associated with producing all of these sandbags and the associated revenue? Well, the short answer, as I'm guessing you have figured out, is no. Let's move on and understand why. First, let's talk about implicit versus explicit costs. Implicit costs are the value measured in dollars of foregone benefits. So think about things that I could have done other than running this business, things that I could have done with the money that I invested in the business, other ways that I could have employed that money or capital. Explicit costs are the costs that require outlays of dollars. So those are really the straightforward ones. Here's an example straight out of the book that I think is a pretty good one. Opportunity cost of an additional year of school. Why do they use opportunity cost here? Really because opportunity cost is total explicit cost plus total implicit cost. So explicit costs plus implicit costs. Well, let's take a look. Explicit costs, those that require outlays of dollars. We have tuition, books and supplies, and a computer for a total of $19,500. Implicit costs, so the value measured in dollars of foregone benefits. In this case, a foregone salary. I could have earned $35,000 in a year, and instead I went to school for a year. So total cost, or total opportunity cost, total explicit cost plus total implicit cost, is $54,500. Already I'm starting to question the way that I computed costs associated with my sandbag business. Let's move on now to the definition of accounting profit versus economic profit. What is the difference between these two? Well, first, accounting profit. Accounting profit equals total revenue minus explicit cost, so those costs that require an outlay of dollars, minus depreciation. This is the first time we've heard this term. And because this isn't an accounting class, we're not going to spend a ton of time on it, but you do need to know that depreciation is an estimate of the annual reduction in value of equipment over time. Here's an example really quickly. If you buy a $100,000 piece of equipment and it's good for 10 years before it has to be replaced, accountants think about that in a profit equation as being a $10,000 expense over the course of 10 years. Again, a $100,000 piece of machinery that lasts 10 years is going to have a $10,000 annual depreciation. Economic profit is total revenue minus opportunity cost of resources. Another way of saying implicit and explicit costs. So both outlay and the cost of what I gave up in my time and the resources that I employed in the business. So let's take a look at the example here out of the book on a cafe. So case 1 and case 2, two different cases because they're two different sets of costs here. First of all, revenue, $100,000 in both. Explicit costs, $60,000. So that would be things like ingredients and energy usage and rent and different hard outlays of money. Here's depreciation on the equipment associated with the business, so $5,000 in both cases. So accounting profit is the same, $35,000. Accounting profit, again, being total revenue minus explicit cost minus depreciation. Economic profit's a little bit different because to the costs outlined here, explicit and depreciation, there are also implicit costs of running a business. So in this case, income that Babette, the business owner, could have earned on capital used in the next best way. So other things she could have done with the money that she invested in the business. So this is a cost because she could have made $3,000 extra doing something else with this money. So we're counting that as a cost against her business. Also, income Babette could have earned as a chef in someone else's restaurant. So we take $34,000 out of the equation here, and here it's only $30,000. That's the only reason case 1 and case 2 are different. Well, when we take this revenue minus all of these costs, we get negative $2,000 in economic profit. In case 2, we get $100,000 minus all of these costs. We get $2,000 of economic profit. So minus $2,000 and plus $2,000. Well, there's also something called normal profit. Normal profit is defined as an economic profit of 0. All that means for the purposes of what we're doing in this class is that there is no better use that the money could have been put to than the way it was used. So if a normal profit, if you get down to the end and your economic profit is 0, that's actually doing fine. It means you couldn't have done anything better with the money than employ it the way that you did. It's a little bit of a weird concept that normal profit is 0 and that's okay when we're all trained to think that we need to make big profits, big positive profits to be successful. In economics, normal profit of 0 is just fine. Well, to wrap up, let's then look at that sandbag business and make sure we understand whether it's actually a good idea or not. Well, let's start here again with the traditional view. $5 a bag times 500 sandbags, there's revenue. Here are all the costs that I had associated with the business. But there are two that I have to add here that were implicit costs. Well, the first is foregone salary. I could have earned $5,000 in the month that I was running my sandbag business, so I have to subtract that amount. And then return on capital that I had employed. So I had to go out and borrow money to buy the sand, borrow money to buy the bags, borrow money to pay my single employee. And I could have taken that money and put it to another use. That use would have given me $45 more, so I'm subtracting here. Turns out my profit is actually minus $4,795. So in fact, maybe that sandbag business isn't as good as I thought it was. Why the difference between this and this? Again, quick summary, total cost, remember, equals implicit costs plus explicit costs. And that is how we figure out economic profit, sort of bottom line, and whether the business that we're investing in, the business that we're spending our time and energy in, is actually creating a positive or a negative return for us. So there you have it. Explicit and implicit costs, accounting profit and economic profit, implicit cost of capital, and normal profit. Have a great evening, and I'll see you tomorrow.